Hello, and welcome to Palisade Corporation's webcast, using RISKOptimizer and Evolver in determining optimal swaps for risk mitigation. Presented by Roy Nersesian, Professor at the Center for Energy, Marine Transportation, and Public Policy at Columbia University. My name is Jameson Romeo Hall, and I will be your host today, and I'll be available to help answer WebEx technical questions by chat. If you experience technical difficulties joining this WebEx session, please dial 1-866-229-3239. At this time, all attendees are in a listen-only mode. Please note that as an attendee, you are part of a larger audience today. The attendee list is suppressed to maintain attendee privacy. We will be holding a Q&A session at the conclusion of today's presentation. You may ask an online question anytime throughout the presentation today by clicking on the question mark icon located on the floating toolbar. I would also encourage you to visit our website and sign up for a free trial download of our software, including our lead products, At Risk, and the Decision Tools Suite. We invite you to sit back and relax and enjoy today's presentation. Roy, you have control. So you can click that quick start and then share your desktop. Looks great.
Okay. Let me get the PowerPoint up. Where is the slideshow? Here we go. Well, I want to thank everyone for attending. The subject matter is determining the optimal level of swaps for risk mitigation. I teach at Columbia University, at Monmouth and Columbia Universities, but at Columbia I use at-risk simulation as part of a quantitative analysis course that I teach at the School for International Public Affairs. And it all started, this little background, it all started when I was talking with an oil guru, and I asked him what he advises oil companies to do with regards to coverage by swaps. And his response was, I just tell them to cover 1/3 of their risk. And that was it. And that started a thought process with me as to if I were asked that question, or if I were put into that position, besides just giving a general thumb rule, is there a quantitative method that could be used to give a more precise guidance as to what would be the proper coverage of swaps? So the first challenge I had to face was, well, if you're going to mitigate against an adverse price change, you ought to have a feel for what the future price is. And I've been around this world long enough to realize that no one can forecast anything, not even with precision. Here I'm showing you a UK government forecast on oil prices in 2008. You see they're high, they're low, they're central, they're most apt, and then you see the actual. So the actual is not even close to the forecast. And I'm not criticizing them. We all forecast, and if we're honest about our forecast, we are usually pretty wrong. And if you do, however, feel that you are a good forecaster, then I urge you to become a trader. Because if you can forecast the price, then you know what positions to take, and you are going to make a fortune. The problem with forecasts is that they assume that there's logic and order in this world. And they are invariably wrong, because I call them wild cards. These are wild cards that are dealt that just change the nature of the business. For instance, in the oil business today, a revolution in Iran. It's going to spike oil prices, and there is nobody who is forecasting that, at least with confidence. So now we're back to a random walk. And random walk simply says that you can't forecast. Fundamental knowledge is no help in selecting stocks. Everything is random motion, and this was a book by Burton Malkiel, and it was very, very successful book. It's interesting, though, in the last few months, he was caught recommending people to invest in China, and of course that requires fundamental analysis, so he may be violating his own rule. But anyway, what he says is really true, that it's very, very difficult to forecast price. And proof, 2/3 of portfolio managers cannot beat the Standard & Poor's average performance. Can you imagine that? All these smart people thinking every day about stocks and stock movements and trends and this and that, and on average, 2/3 of them cannot even keep up with an unmanaged average, which only, I'm not insulting these people, they are very smart, I know a few of them. It's just the difficulty of forecasting. And there are forecasting techniques that are really do seem to assume a random walk. One is just buy the index funds. Don't buy the stock. They can't pick the stocks anyway, so just buy the index and just perform with the market. If you perform with the market, you're going to be doing better than 2/3 of the portfolio managers to start with. Others say use the index funds and then use a cash account and then just play. You know, if you think the market's going to go down, put more money into cash. If you think it's going to go up, put more money into the index fund. But I can tell you right off the bat that's not going to be overly successful for most people. And we have other people who say you cannot select a stock, but maybe you can select a stock group. And that's one of the popularities of these ETFs, is that you can buy stocks in a particular industrial group. And but the point there is you can't pick the stock, so you pick the group. Yet, in hindsight, when you look at past stock movements, stock price movements, there's always a story. You can. In the 1970s, for instance, the Hunt brothers and their speculator friends decided to corner the market in silver, and silver went from a couple dollars up to $50 an ounce. And so there was an explanation for it. If you knew that was happening, I guess you could take a position. And what these characters did was they just basically bought up all the futures contracts and then squeezing those who went short. So the market was clearly up at 20. Silver was excessive in price. You shorted the market. These guys would just keep buying. When the silver got up to 25 or 30, you had to close out or you're going to lose a fortune. And, of course, that means you're just adding to the buying pressure. So there's the father. It's the sons who went and did this. But what the sons did not anticipate were thousands of people selling their treasured silver plate, dinnerware, and family heirlooms to silver merchants, not for the intrinsic artistic value, but for the value of the metal that was in it. And this melting down of tons of family heirlooms inundated the market and wiped out the family. The family went bankrupt. The Bunker brothers were underwater permanently. And so what this father made in one generation, it was gone. So if you're unable to forecast future prices, and I urge you, if just forecast what the Standard & Poor's is going to close today or tomorrow. Just do that. Just try it for a while and see how good you're at. Then perhaps there is certainly the appearance of randomness. And perhaps investing or forecasting is nothing more than throwing a die. So to evaluate swaps, I must first model price. And so what I did was I went into history and I took a look at the price changes. And here's the daily change, and I just want the absolute value of the price change. So I want to get a feel for the price change because I'm going to use that price change to create a model. What's interesting about this, of course, you see here oil is 40. Right now it's around 105. For a century of time, over a century of time, oil was between $2 and $3 a barrel. So there was no point in having any swaps back then because you didn't have any volatility or enough volatility to worry about. Same is true for a lot of the commodities today. The only reason why you have swaps and derivatives, this and that, is because of price volatility. And going back, gold was $35 an ounce for a generation or two, and oil was $2 a barrel, and British pound was worth $5. Everything was more or less fixed for the longest period of time. You didn't have to worry about volatility and what it might do to you. And so you didn't have any need for swaps. It's only in the recent decade or so that you really need derivatives to protect you from adverse price changes. So what I do with that column that we just saw is through Excel, have Excel create a histogram. And so I have here about something over 1,200 days of history. And of that 1,200 days of history or so, 660 were the price change was $1 or less, or 50% of the time, the price change on a daily basis is less than or $1. And 80% of the time, how many am I a little more? Here it is. 80% of the time, it's $2 or less. And 91% of the time, it's $3 or less. Or I can just subtract these two if I wanted to. The probability of a change in price between $1 and $2 is going to be 80 minus 50 or 30%. But I'm not interested in the discrete probability. I'm interested in the cumulative probability. And then you could have Excel graph it. And so here's the graph. Here's the number here. And over here is the cumulative probability. And on the x-axis is the price change. So what I want to do is actually switch the axis. This was the old x-axis, the price change. This is the old y-axis, the cumulative probability. And you can see here the cumulative probability of being less than $1 is 50%. So here's $1, and I drop down, and the cumulative probability is 50%. If I go to $2, go on over to the curve, drop on down, it's 80%. So this is the same curve I had before. I just changed the axis. Now, the reason why I want to do that is because I'm going to take this cumulative probability, and it's going to become a random number. So if I draw a random number of 0.5, the price change for the day will be $1. If the random number is 0.8, the price change for the day will be $2. If the random number is 0.2, it's going to be something like 40 cents. So I'm going to use this curve as my driver in a simulation to create a future price. Then I'm going to have swaps, and then I'm going to measure risk mitigation against that future price. And, of course, the future price can be up or down because it's basically going to be random. So we have a large probability of a small change, 50%, $1, and therefore a very small probability of a large change. The formula I'm going to use is a to the x minus a, but x is going to be b to the y. So basically I have two exponentials, and y is going to be another constant times the random number, and this is going to be my cumulative probability. So A, B, and C are unknown quantities, variables. And if they were in cells B18, B19, and B20, then the formula for the cell is B18 raised to the power of B19, which is in turn raised to the power of B20, times the random number minus B18. And so when the random number is 0, this quantity is 0. B19 raised to the 0 power is 1. And therefore, B18 raised to the power of 1 is B18, and B18 minus B18 is going to be 0. So when a random number is 0, my change will be 0. But I can't have a purely random price generator because it can generate negative values, and that can't happen. And so I have to have a system where I control the extent of the price. It can't be too high, and it can't be too low. So I'm going to have to pick a high point. I'm going to introduce what I call the propensity to sell, which I'll explain in a moment. And if the price gets too low, I'm going to have a propensity to buy, and I'll explain that in a moment. The trick is estimating what is too high and too low. That's another problem. And the caveat emptor is that because you look at past data, it's not going to tell you what is going to be in the future, the high price and the low price. As a matter of fact, past data do not normally relate very well to future price patterns. And that is a problem. It's a drawback, quite frankly. So I'm going to, the starting price, of course, is always known. I'm going to have to assume a highest price and a lowest price. That's all I really have to assume. These upper and lower limits are areas of transitions. That's not really that important for now, but what is important, I have to select the high price, the highest and the lowest price that I expect. So it's just three numbers that I need. The starting price, which is no problem, the highest price and the lowest price is what I need, and that's a problem. And so I have picked the highest price of 180. Historically, it's been 147, and this lower limit of $40 is a number I believe we will never see again, but I need a low number, so I have one. So here's my $40, and here's 50. Between 50 and 170, the bias to sell or to buy is going to be 50-50. So this is purely random. It's a 50% chance the market will go up, generate a +1, a 50% chance the market will go down, that's generating a -1. Then I go through this period of transition from 50 down to 40. When I get down to 40, the propensity or the bias to sell is only 10%. So there's a 10% chance of generating a -1, a 90% chance of generating a +1. So when I get down below $50, and as I work my way down to 40, the chance of generating a +1 climbs until I get up to 90%. And it's kind of interesting when I do a simulation that I will get prices below $40. Even though there's a 90% chance that the market should be going up, I still could draw out every now and then a bunch of minus numbers, even though there's only a 10% chance of doing so. And similarly up here at 170, with the propensity to sell or bias to sell is going to climb from 50% up to 90%. So when I get up to a price of $180 or more, and I roll the die, there's a 90% chance of generating a -1 propensity to sell, and only a 10% chance of a positive one. And even so, if I look at these simulations from time to time, I will get prices above 180. They don't last too long. They don't go far above 180, but it's not an absolute true barrier. So on a spreadsheet, I'm going to have an A and a B and a C factor, which I don't know. What I do know is the 50% cumulative point will go through $1 per barrel. The 100% cumulative point will go through $10 per barrel. And the objective here is, the little mouse likes to die. Oops. There we go. The objective here is to assume values over here such the objective of number one, the 50% cumulative point is going through $1, and the 100% cumulative point is going through the $10. So that this number down here, the objective, which is the sum, the absolute sum of objective 1 and objective 2, we want that to be close to 0. That's the objective. So the A, B, C factors are not known. I do know the cumulative probabilities for 50 and 100%, what their value should be. And this just shows the same curve I had before. I wanted to go through the 50% going through the $1 and 100% being $10. And so I have the RISKOptimizer. I can use either RISKOptimizer or Evolver. If I use RISKOptimizer, the only thing I have to do is the iterations has to be 1 because I don't have any distribution. I had no probability distributions in this. So this changes RISKOptimizer to Evolver. And the menu is the same for RISKOptimizer or Evolver. I want to minimize cell E23. That's the objective cell, which is the sum of objective 1 and objective 2. I want to vary B18, 19, and 20 from 0 to values that I know that the answer is going to be somewhere in this range. If the answer were close to this, I would expand the range and then okay. And when I do that, this is what I get. The A factor is 1.3, the B factor 9.5, the C factor 0.9. Here's my cumulative. This is my desired. This is my actual. And it's not zero. It's close to zero. Here's the formula for objective one. It's the generated value for a random probability of 0.5. That's what this number is. And minus E18, that's this number up here. And I want that to be as close to zero as possible. Similarly, this number here, the objective is this number, which is the formula, but with a random probability value of 1 in it, representing 100%, and minus E20, which is the $10. And I want this plus this to be equal to, got to be careful, this plus this absolute value to be minimized. Rounding is why it's at 4 cents and not 5 cents. And this is what I get. And when you look at it, the 50% is going through the $1. At 100%, it's up at $10, just where we want it to be. But interestingly, and I just noticed this today actually, the 80% value, remember, was at $2, went through the 80% value. And you see the line is not going through there. The line should really be a little bit more down south. So what you could do, and I think I've tried experimenting on this, is to have three objectives. The 50% going through $1, the 80% going through $2, and the 100% going through $10. And as I recall, you sort of get a compromise curve. You can't really satisfy all three conditions. So in other words, the curve does not hold for all the patterns of price changes that can be generated, but it's close. And maybe some further effort could go into this someday. But anyway, with that curve, I can now start generating prices. So the price starts at $80, and from this point on, it is just plus or minus 1 times a change. And this is, so I can get bearish patterns, bullish patterns, any pattern you want. All I do is just keep hitting F9. So I'm going to be running a simulation using these price patterns, 10,000 of them as a matter of fact, and putting in different levels of swaps and just watching what the output is. So this is one of my range results, and what I noticed is the trading range over the course of the year of the price of oil is really high. But then again, remember, I am using a low of 40 and a high of 180. But nevertheless, if I had a narrower range on my future price of oil, then the range numbers would be less. But this shows you that there's a great deal of potential volatility in the price of oil when you start running these. Of course, this is over a 5-year period, but nevertheless, there's a lot of volatility. Also, if I run a simulation on last price, the year 5 price, and see what it looks like, I always get this pattern. You do not get a normal curve. You get what is almost a uniform curve. And what does that mean? It means that since risk is always in the high or low values, you're going to get greater risk than if this were a normal curve. Or what is really saying is that there have been people who have commented that the normal curve underestimates risk. And I agree with them, because if tomorrow's price is today's price plus or minus some random quantity, you're not going to get a normal curve. You're going to get something much closer to a uniform curve. That means fatter areas in the tails and therefore higher risk. So I'm not sure why it doesn't turn out to be normal, but this is the way it turns out. It's more of a normal distribution. So now I have to have a problem. So here is, I'm running oil price on a daily basis, but I only look at it every 20 days because I'm working on a month, 20 trading days in a month. So there's my price of oil. Here's the volume. It's a well that produces 100,000 barrels per day and slowly increasing. Here's my revenue with no swaps. It's simply 30 days of this price times this volume. Then I threw in some debt and operating costs, flat of $330 for now. And I have a little negative cash flow here and positive cash flow beneath because my price is going up. Over here I have minimum working capital, and that, by the way, is risk mitigation, to have a minimum working capital requirement. And if my working capital, if this number less the cash flow is less than $1 million, I cannot pay out anything. And here I have positive cash flow. My working capital goes above $1 million. That excess of $1566 I can spin off as a dividend. And here I'm 76, so obviously I'm above the million. I can spin all of that off. So the way this system works is dividends can only be paid when the working capital is above the minimum. And this is a risk mitigation tool. If you increase this number to 2 million, you'll be surprised how it does reduce the risk of loss when you have a low price of oil. So the oil price every 20 days to mimic monthly readings. Right, we covered it all. So now I run a simulation. And now I have the reward is the sum of the dividends over the period of time that I'm looking at. That's my reward. And my risk I measure as the number of months that I have negative working capital. Negative working capital means I've exhausted the $1 million. This is not negative working capital. It's when this number becomes, over here, becomes an actual negative number. How many months do I have negative working capital? In this case, none. And what is my maximum negative working capital? Well, since I don't have any negative working capital, that is 0. So I'm talking about negative working capital. That is, I have exhausted that $1 million. It's a deficit. So this is a run, a simulation, or an iteration, actually. Here's another iteration. Now look here. This is when the price of oil falls below my starting point, which I think was 80 or 90, I forgot right now, but it fell below my starting point. And I'm developing all these negative cash flows. Here we can see the working capital going negative. Excuse me. Down here. I'm not paying out any dividends because my working capital is less than $1 million. So in this particular run, how much did I pay out in total? I paid out in total 0. And I had, in this case, 50 months of negative working capital for the run, and my maximum negative working capital was $2.7 million. So we have a lot of volatility in the results. So when I run a lot of simulations and then look at what I develop, you can see here that there's a 19% chance of not making a dime. That is, the dividend throughout the whole period of time is 0. Over here you can see the mean. The mean of the of dividends paid is 4.5 million. And so 80% of the time I do get a dividend, 19% of the time I don't at all over this period of time. So that's my reward. My measures of risk, I have a 58% chance of having at least 1 month of negative working capital, and the average is 17 months. And I'm going to have the same chance of a negative working capital, but here I'm measuring how bad it gets, and the worst it got was $1 million. I shouldn't say that. The worst was $6 million. The average was $1 million. So now I want to introduce the idea of swaps. And swaps is basically an exchange of payments, not an exchange of physicals. So if the market price is above the swap price, then there's going to be a monthly payment in one direction based on 30 days times the amount of oil that I'm producing times the difference between the market price and the swap price. And I ought to take that back. I see it's 1,000 barrels per day. So I'm buying swaps in units of 1,000 barrels per day. So if I buy 1 unit, it's going to be and the market price is above the swap price, and the monthly payment will be 30 days times 1,000 barrels per day times the difference between the market price and the swap price. And then down below, it's just the same, except covering the case when the market price is less than a swap price. Then there's going to be a payment in the other direction. And this is what's going to mitigate our risk. If the market price is below the swap price, that means this is the time when I'm not going to be making as much money as I need. I am going to be getting money from the swap counterparty equal to the difference times 1,000 barrels per day per unit times 30 days. So that's my risk mitigation. That's good. What is the cost of the swap? The cost of the swap is as the price goes above the swap price, I'm going to have to make a payment in the opposite direction to the swap counterparty equal to 30 days times 1,000 barrels per day times the difference between the two prices. So when times are good, I have to forfeit some of my profits. But when times are bad, I'm getting additional revenue. So the cost is the diminution of dividends. The benefit is the diminution of risk. So I then take the little spreadsheet and I add another column to it. I put in here swap cap and floor and the swap volume. And I have someplace in here the revenue with the swap. And the revenue with the swap is this terrible looking formula right here. But it's not so bad. If at the end of the month, if the price is greater than the swap cap, then the revenue is the difference times the amount of the swap volume. And if it's below, that's over here, that condition is not true. And if it's below, then the revenue is going to be the floor price times the swap volume times the difference in price. And if both conditions are not true, that is the prices between the cap and the floor, here they're the same, but if these numbers were different, then there would be no exchange of funds. This actually is called a swap collar, where you have a higher price for the cap, a lower price for the floor, and nothing happens in between. When you make the two prices the same, then the collar becomes a simple vanilla swap, plain vanilla swap. So the formula just is very conducive to setting it up as a collar, but we're just going to be using it as a swap. I have 50 units here, so that would represent 50,000 barrels per day, and max is 100,000 because I don't want to have more swaps than volume. And so I get a different cash flow because of the interaction of the swap with the revenue. And now I can look at the differences. So the measure of reward with 50 swaps, that's 50% coverage. There's an 83% chance of receiving dividends versus the 58% chance without the swaps. So that's a benefit. But the average dividend goes from 3.2 million versus 4.5. So there's a cost to the swap. The cost to the swap is that over time, I'm going to receive less dividend payout, less profit. I'm forfeiting some of my profit in order to reduce my risk. And how do I reduce the risk? Well, when times get bad, money is flowing in from the swap counterparty. And so when I take a look at months of negative working capital, I start with the protection. With the swap, there's a 36% chance of 1 month, of at least 1 month of negative cash flow with a mean of 9 months out of 50, whereas with the unprotected, with the original case, a 58% chance of having negative working capital with an average of 17 months. So I have reduced the chance of having negative working capital, and the number of months have gone down. When I took a look at the maximum negative working capital that I achieve, Then with the swaps, there's 35% chance versus 58 unprotected, and my average loss is going to be $250,000 versus what I had before of $1 million. So clearly, I have reduced the risk, but the cost is a reduction in the dividend. So what do I do now? Well, to find the optimal level of swaps, I would have to do several runs, not too many, maybe 25%, 75%, just fool around with different swaps, and I have to examine the reward, the amount of dividend, and the risk, the reduction in the number of months and in the amount of the negative cash flows. And I probably will come to the need to make a judgment. Personally, I would plot these for different types of risk and see what they look like to make that judgment. I could use RISKOptimizer and make the number of swaps a variable. That is an obvious solution. The problem is that you must properly identify the objective cell. And the ones that I use is just to maximize the difference between risk and reward, the risk being the maximum of the negative working capital and the reward being the dividend payment. And the couple of times I tried it, it did seem to work. I'm not going to guarantee it, but you can use RISKOptimizer to actually get the answer. I would probably look at this. I would do both. I would plot the results so I have a good feel for what it is, and then also run RISKOptimizer and see how that falls in with the plot, and then make my judgment. But we need not stop at variation in crude oil prices. I can now expand the market to include a floating interest rate risk. So I then go into the London Interbank offering rate over a long period of time. I say I started in 1990 to get the absolute monthly change. Once I get that list, got to be very careful. Once you get that list, I do a histogram. Now, this is all in Excel. And then from the histogram, it gives me the cumulative probability. And then I'll just do as I did before. I want to drive down the 50% cumulative position to what it was, and 100% using RISKOptimizer or Evolver. And here I'm doing the runs. You can watch the objective cell getting closer to 0. And my objective was for the 50% cumulative point to be at 0.13, 0.15%. You see it here listed as 15. I found that I can get better results, or the RISKOptimizer behaves better rather than having 0.15 using 15. And so I get a formula, and I have to divide that formula by 100 in order to get the interest rate. But it seems to work better if I just multiply the interest rates by 100 and try to get an answer. And so here's the shape of the curve, and now I can now I have values for this function, and I can incorporate the function into the spreadsheet. Here is a couple of iterations of a simulation on the interest rates. And so I then went in and I split the $330,000 that used to be here. I split that into 3 payments: $100,000 for operating costs, $150,000 for debt repayment, and the interest rate of $90,000. And this is I'm going to be applying the swaps to the interest rate, and the interest rate will vary by that formula that I derive from the price changes. So if I have no swaps, and this is with regard only to the interest rate, I'm going to keep these constant. And on the interest rate, if I have no swaps, the mean is 26 months of negative working capital with a 24% chance of no working capital and a 14% chance of exceeding negative working capital exceeding 50 months. With the above swaps, the mean falls from 26 down to 21. The chance of no working capital goes up from 24 to 35%. That's good news. And the chance of being over 50 months falls from 14% down to 2%. So obviously, I have reduced my risk associated with a floating interest rate. And the maximum working capital with fluctuations in oil price, with fluctuations in interest rate, falls from $2.8 billion down to $1.2 billion, so that the cost of risk mitigation is $1.6 billion. Again, this is strictly on the interest rate. I keep the oil swaps constant, and the amount of the most negative of the working capital goes from $1.6 billion without the swaps to $0.8 billion. So the cost of mitigation is high. That is, there's a large reduction in the dividend. I have to find it. Oh, here it is. The cost is right here. The dividend is $1.6 billion without the swaps, and with the swaps, $0.8 billion. So again, my problem is the reduction in dividends, but I also have a reduction in risk, and I have to do an evaluation. And then I can add more risk. I can now bring in that the bond is in euros, not in dollars. And so here is the change of euros over a period of time. Here's the absolute. Here's the histogram. Here's the cumulative probability. Here is the A, B, and C factors that describe this curve. I can then put into this on the interest rate swaps, the interest rate, and I think debt repayment, but I'm not sure at this moment. But anyway, I can incorporate the currency exchange rates, and I can use the same methodology. And how would I, now this gives me an awful lot of cases to examine. With a single swap, you can do it manually. But when you have all of this, I did switch over to RISKOptimizer, and I did use as my objective function for RISKOptimizer to maximize the difference between the reward and the maximum negative capital. And it worked. I'm not sure if it's a perfect answer, but it certainly, I did get an answer. So it did make sense when I did it, too. But so there's a lot of experimentation still going on, but I think that this really provides a foundation for the use of evaluating the amount of swaps in order to, in this case, handle variations in oil prices, currency exchange rates, and interest rates. And this is the spreadsheet that I used. I'm going to change the subject a little bit as I go on, but this is the methodology, and I was happy with it. I don't know if anyone uses it. I do teach it, but to me, it just gives me a better answer than just saying, well, protect 1/3 of your risk, which, by the way, could be correct. But I just feel more comfortable being able to do some kind of an analysis to provide what I would consider to be a more optimal response to that question. So I'm going to change the subject a little bit, but it's akin to it. The nominal value of swaps outstanding at one point in time was 0 because prices were relatively constant. There was no need to go into derivatives. In 1993, there was $7 trillion. Currently, it's over $600 trillion. I've also heard $700 trillion. That's a big number, because the world global GDP is $70 trillion. So the nominal value of swaps overwhelm the global GDP by a factor of 10. And why is this so? Here's another form of swaps coming out, by the way, credit default swaps. And what's interesting about credit default swaps is that they do not have a bond issue in mind. It's just a credit default swap on the company, and if the company goes bankrupt, it presumes that the nominal bond that backs this up is worthless, and people collect one way or the other. So it's this is a very actively traded market, credit default swaps, totally out of control, by the way. But everyone is in it because if you want to bet against Portugal, it's very easy to do so. You just short, I suppose, a credit default swap, or you buy one. Excuse me, you buy it. And the people who say that Portugal is not going to swap, go into bankruptcy, they're going to be on the other side. This is why AIG went bankrupt. They were on the wrong side of these credit default swaps. And what did that mean? It meant that, you know, billions, trillions actually, of government money had to be forced into the banking system to keep it solvent under these trying conditions. So here's risk mitigation is actually increasing risk. So why are there so many swaps? I visited a shipping company. They have real ships, and they have 6 people fixing real ships on various charters. Interestingly, they have 6 people playing the derivatives market on virtual ships, ships that don't exist, make-believe ships. And so here's my make-believe ship, a virtual ship. So you can see the use. Suppose existing ships are on various charters for the next 2 to 3 months, and you have an assessment of the future market that's going to weaken after those 2 or 3 months. If you didn't have derivatives, there's nothing you can do, assuming for the moment there are no charters more than 3 months available. But because you do have derivatives and you have a virtual fleet, that is a fleet of non-existing ships, you can fix those ships with shipping derivatives out into the future. So if the physical fleet is making money and then goes through a period where it's not making money, then the virtual fleet will make the money for you. So I can understand the concept. Example of a swap, what is, okay, example of a swap, this is the first part of it. What would you pay for a floating rate loan from a few days maturity to 12-month maturity in 2005? Well, you see here, this is what you would actually pay. Now let's go to the next one. Suppose you want to enter into a swap. Well, you can enter into a swap, and you can see how long to go out into the future. They'd be 1 year, 2 years, 3 years, all the way up to 30 years in the future. And this is the rate you would pay. It's a little bit higher, 5.5%, if you recall on a previous slide was the floating rate. But if you want to fix it at 6, you can go out 3 years. If you go up to 6 3/4, you can fix that out for 30 years as a fixed rate. But if had you entered into this swap, it would have been a disaster because the floating rate fell to close to 0, and you have fixed it at 6%. So instead of the market interest rates going up and the swap cutting in to hold your interest rate at 6 3/4, the point was that what actually happened was interest rates went down, the floating rate went down, and you have just locked yourself into a 6 3/4% fixed rate when if you left it at floating rate, it would be 0.2%. So what are you going to do? This charter of the virtual fleet, the charter of the physical fleet at the end of the day went home. The charter of the virtual fleet at the end of the day had to go to the chief financial officer and go through every derivative position that was on the books and determine if money was flowing in or flowing out of the firm. Of course, if it's flowing into the firm, that's fine. If it's flowing out, what are you going to do to stop the flood? So he was put on the line for every derivative position where the firm was paying money out. So what do you do? Well, what you do, and you have no choice because the chief financial officer is all over you on this one, is that you must enter into a derivative position of an opposite type swap to neutralize those positions that are a cash drain. The system will force you to do that. So you have a swap to protect you from oil falling below $90, and if it's starting to rise above $90, that means you're paying the counterparty. You want to go into an opposite swap. So as the price continues going up, you're paying more out on the first swap, but the second swap, money is coming in. So your derivative positions just pile one on top of the other, neutralizing previous positions that turned out to be wrong. And let's face it, in any swap, 50% of the time, you're going to be wrong. And this idea of treating this cash outflow as an insurance premium in order to obtain a hedge against a potential loss, forget it. It's a cash outflow, and that's got to be stopped. And so there's tremendous pressure now on a person who runs the virtual fleet to do something to staunch any bloodletting. And so I created a little program, and this little program, and Palisades helped me out with this one, by the way, is we started an oil project. The output is about 100,000. Here's your output, 100,000 barrels per day. But we want to mitigate risk. The risk is a low price, a price falling below 90. And to do that, we have already entered into a swap of 65,000 barrels per day versus the 100,000. So we're about two-thirds protected at $90 for 5 years. And so if the price is above $90, we're going to be sending money out. If it's below $90, money is coming in because we want to protect ourselves against risk. So that's already a given. And so I make the player of this game is the swap manager. So the company has entered into a swap at $90 to protect against the fall, and right now the price is going up over here. So if we go all the way over to the swap, we can see money is flowing out of the firm, and it's up to $241,000 on Friday. And you can well imagine on Friday when the swap manager meets with the chief financial officer and he notes that he has to write a check for $241,000, the pressure is going to be on the swap manager to do something. Well, what can you do? So let's just suppose the swap manager on this Friday here enters into a 20,000 barrels per day for 3 months at the current price of $93.70, the opposite swap. And then you then hit the new week, and then another 5 days goes by, and what we see over here is the price really went up and then came down. So as we go all the way across the page, now the CFO has to write checks for $500,000. You know he's going to be very upset about that. And here's your new swap. You were right. The swap price is $93.70. We went above $93.70, so money is coming into the firm. But it's not nearly enough. In fact, the total benefit of entering into that swap is $551,000 over doing nothing. And so you know the pressure is going to be on to enter into another swap at the end of this week. And so you fill in these. The price is the swap price is the Friday price. The player has to put in the quantity and the duration, and then hit new week and see what happens. And I can tell you if the price kept going up, the pressure will be on to add more and more and more of these swaps. But then when price starts coming down, all of these swaps that had been established to protect yourself against the rising price will now become negative outflows, and now the poor swap manager has to enter into the original swap in order to protect himself. You can just feel the deluge of swaps that's going to be generated because you entered into one to begin with, and that one you were on the wrong side of the transaction, and now you're trying to rectify the mistake. So this is a game called the Swap Game. It's going to be part of a series of 3 books that Palisade is putting out. These are the workbooks. The first one is actually the workbook I use up at Columbia. And when I get into the subject of the oil hedge, and basically what I showed you is from the book, at the end of the chapter, I enter in the swap game, and so that the students can play this game and just see what happens to them. And I know what's going to happen. The price, they're going to pile up all these swaps, and then the market's going to move against them, and then they're going to have to keep adding more and more swaps. So it's very obvious to me at this point why swaps are 10 times the size of the global GDP. I went to the investment banker with my idea to help him advise clients on how many swaps they should take. I was talking to the blind and the dumb. He had no interest in my work whatsoever. The only comment I could elicit from him was this: all we want is for a company to enter into its first swap. I understood after a while why he had no interest in my work and was only interested in their getting into their first swap, because once you are into a swap, one of those parties will be wrong by definition. And therefore, they can come back time and time again and offering new swaps as a personal favor in order to cure the outflows that are being generated by the first swap. I did experiment with the alternative of what I call business risk insurance. And so I have the nominal cash flow, I have a working capital, and again, the amount of working capital is a risk mitigation tool. The more working capital you have, better things are from the point of view of mitigating risk. And so here I exhausted my working capital, I have negative cash flows, I want to have this is my, this is my nominal negative working capital, and I want to submit a claim to keep my negative working capital at 0. So what would be my insurance rate? Well, here I have the base premium, and so the base premium holds when my reserves are adequate. That's down here someplace. You see it's $70,000. When the reserves are more than adequate over the $2 billion, you can see that it drops to $20,000. And when they get down to, if the claims get down, my reserves turn negative, the emergency premium cuts in. That's very high. And so the only number that I'm asking RISKOptimizer to solve for is this base premium. So these are the numbers I have put in. And so I set up, here are your reserves. Here's the reserve income, plus or minus the amount above or below the reserves. The reserves actually is somebody's pension fund. It's not actual reserves that you have to have. And here are the claims. And what I want to run, I want to run the program to determine what this number is in order that the objective, which is the beginning and ending reserves, are around 0. The beginning reserves, I know what they are. That's $2 billion. I want the objective, the ending reserves, to have an average of $2 billion. So I can then run Evolver or RISKOptimizer in order to get the base premium. And then once I get the base premium, then I can apply it to that's my insurance premium in the previous spreadsheet. And so here we have the reserves, the ending reserves, and the initial reserves of $2 billion are inadequate. That number was also arbitrarily selected, but RISKOptimizer permits me to find out what is the optimal amount or the needed amount of reserves, and I can do that right here. What is the probability of exhausting $2 billion worth of reserves? Well, it's 12.5%. That's too high. If I increase my reserves to $10 billion, then the probability of exhausting it is down to 0.3%, which is something that people can live with. So I can get the base rate, and I can get the amount of reserves through RISKOptimizer and through at-risk. So in this particular case, I then combined the concept of an interest and currency exchange rate swaps, nothing on oil, no swaps on oil, just interest and currency exchange rate swaps, and along with a business risk premium, and I had a major reduction in a business risk premium from $70,000 down to $12,000. So that tells me that there are combinations of swaps and business risk insurance such that we can control risk. Right now, since I got on the subject of basically forecasting the imponderables, the future, I took a look at developing an algorithm to forecast chaos being the Standard & Poor's 500. And I developed a little algorithm that works off the opening, high, low, and closing price for the day, the volume-adjusted price, it's price divided times volume divided by a scaling factor, the velocity and acceleration of the volume-adjusted price. The velocity is it going in a positive direction or negative, going up or down, and is it accelerating? Is velocity going faster? The rate of change per day is getting greater, or is it getting smaller? Then I threw in some wave patterns, some sine curves, and I then took a look. This is historic now. Take a look at the history, and I have a whole bunch of constants that have to be evaluated, and Bava does that for me. And what I want is I don't want to maximize profit. I want to maximize accuracy. So here are a bunch of buys. They were for the values that Evolver generated. They were all 100%, and I had 19 transactions. And so my objective function is to add up this curve, subtract 2 times the losses, plus the number of transactions. So 8 is 100% plus 0.19, number of transactions divided by 100. So that's my objective function. And again, working only off past data, this is what my buy signals are. This is when they are generated. And they're generated on a basis of 3 days of improvements. And then I did it on the shorts. And then I did my experiment. And my experiment, of course, is to run the model daily after the close, see if there's a buy or a sell signal, and then as time goes on into the future, figure out if I made or lost money. So during the time period that I was doing this during 2010, 4 months, I had only one buy signal in June. I may not have been doing the entire month. I'm not sure of that. But in July, which is a full month, I had 5, 4, and 6 buy signals, of which 7 were correct and 1 was wrong. Oh, excuse me. I had 19. I had 19 buy signals, 17 wins, 2 losses, and 8 short signals, 6 wins, 2 losses. So this is running the model at the end of the day, seeing if there's a buy or sell, and then letting the future spread out before me and see if I made or lost money. And if you're interested, I have a little this is my, I have a website. It's not too much on it, it's just 1 page. But at the bottom, I have a little bit of a write-up, and then I give you the same results that you just looked at with a little bit more detail. I'm not doing anything with it now. I just started it, and well, that's where I stand on my research, and I think I think I'm about over. So I'll take any questions and answers.
Roy, that was great. Thank you so much. Oh, my goodness.
Okay. I went an hour, too. That's just what I'm supposed to do, I guess.
Oh.
I think.
That was really informative, and some of it is frightening.
Yeah. Actually, it is very frightening. I find it frightening. I understand why the financial system almost collapsed. Once I got into this and see the risks that people are accepting, where they're supposed to be mitigating risk, they are accepting risk. That's the problem.
Well, I think we do have a couple questions here. We have time for maybe three or four questions. There is one question: would you be willing to share any of your models, or do they have to buy the book?
I could share the models if you just send me or go through you, Jameson, if you don't mind, and just send me the email. I can send you the applicable chapters and the applicable spreadsheets. But if you wait, and you really have to be patient with Palisade, they will eventually publish the book. But if you make a request to me, I'll handle that.
Oh, good. Thank you. And let's see, I have a question.
Because Palisade may object, but I'm willing.
Do we have any other questions? No, we don't object to any kind of
Okay.
And any other questions here? If you're watching this recording sometime in the future and you have questions, please send an email to me, and we'll just wait a minute. Good, I have the... Wait a second. Well, good, there are a number of people who've chimed in and would like it. I'll send out a follow-up, and I'll have some information in that.
Okay, what I do, James, if there is a group of people, I'll send you the package, if you will, and then you can send them out to the people. Or they can send it, or you can forward it to me. That'd be fine. Either way.
That'd be perfect. Well, maybe we don't have. That seems to be the only question we have so far, except for some reviews that say excellent presentation.
Okay, thank you.
Well, I want to thank you, everybody, and once again, if anything occurs to you in today, or if you're watching this recording, we certainly would like to answer your questions. And thank you so much, Roy.
All right, my pleasure.
Let's do this again.
Anytime.
Yes. And you're going to be presenting at our conference in Las Vegas?
Yes.
And we look forward to that, too.
Fine. And that will be on the contents of the 3 books, which include what we just covered.
That's going to be great. Looking forward to it.
Okay.
Thank you. And thank you, everybody.
All right. Goodbye now.
Okay. Bye, Roy.
Bye.